Bitcoin, or cryptocurrency in general, has got to be one of the hottest topics of investing in 2021. Every man, woman, or dog has either heard of or made a lot of money by investing in crypto. Last week, I was literally stood outside a cafe in Sheffield, of all places, listening to a conversation between two builders talking about Bitcoin. If that doesn't show you that things are getting out of hand, then I literally don't know what does. But whilst Bitcoin and other cryptocurrencies have been on a wild ride recently, at the end of it all, there are taxes to be paid. In this video, we're going to explain how taxes work for cryptocurrencies in the UK. Then, we're going to discuss some of the methods that you can use to avoid paying these taxes. Make sure to stick around to the end of the video, as there's a good chance that you won't have heard of some of these crypto tax loopholes. Quick shout out to Damien Talks Money, who was the inspiration for this video. He's got some great discussion on the topic, and if you haven't seen his channel already somehow, then just make sure to check it out. Also, we just wanted to remind you that we are not professional investment or tax advisors. So, if you want independent financial advice tailored to your own circumstances, then seek that from a professional. With that out of the way, it's about time that iQinvesting finally jumps into the world of crypto. Let's get into it. Bitcoin, Ethereum, Dogecoin. Cryptocurrency is on fire. In the last year alone, Bitcoin has increased by 7 times in value, whilst Dogecoin has increased by 5 times over the last month. Cryptocurrency is a relatively new asset class that is generally poorly understood. Nevertheless, there is no doubt that it has made thousands of investors from all around the world rich. And what happens to the rich? They get taxed. But how on earth does it work? Well, cryptocurrency is treated as an asset, not a currency. So we have to pay capital gains tax on them. Capital gains tax is a tax that we have to pay when an investment that we owned grows in value or makes a capital gain. Capital gains tax is paid on the amount that your investment has grown from the point when you bought it to when you finally dispose of that asset. This not only applies to cryptocurrencies, but it also applies to both stocks and shares and properties too. As investors in the UK, we currently get a capital gains tax-free allowance of up to £12,300 each year. This means that we are allowed to make £12,300 worth of profit on our investments without having to pay tax on that. It's worth noting that you only have to pay capital gains tax on an investment when you have disposed of or crystallised that asset. The main way to dispose of your cryptocurrency is, of course, to sell it. But transferring your cryptocurrency to somebody else, whether that's through a purchase or just a gift, or swapping your cryptocurrency for another one, is also classed as disposing of your crypto. You can think of disposing of your crypto as locking in the gains that you have made on that investment. Once the crypto is disposed, you lock in the gains, and you pay capital gains tax on those gains. So yes, that does mean that if you bought some Bitcoin 5 years ago and it has grown in value by say £100,000, you don't actually have to pay capital gains tax on that until you dispose of it. So if you never sell your crypto, you're never going to have to pay any tax on the gains that you've made. But of course, if you're a crypto investor, you're going to want to cash in on your gains at some point. So I'll explain how capital gains tax works when it's triggered. There are 2 different tax rates for capital gains tax depending on your total income. If you're a basic rate taxpayer, that is with a total income under £50,270, then you'll pay capital gains tax at a rate of 10%. If you are a higher or additional rate taxpayer, that is with a total income above £50,270, then you'll pay capital gains tax at a rate of 20%. It's worth mentioning that any taxable gains that you make from your investments will also contribute to your total income. I'll explain what I mean by that in this example. Let's say, for your full-time job, you have an annual salary of £40,000. Last year, you bought £10,000 worth of Bitcoin that has now grown in value to £30,000. You decide to sell all of that Bitcoin, so you're locking in the gains of £20,000. First of all, you need to subtract the £12,300 capital gains tax-free allowance. That leaves you with £7,700 of taxable capital gains. You would have to sum together your salary and your taxable capital gains, which gives you a total income of £47,700. As this is less than £50,270, you'll pay capital gains tax at a rate of 10%. So 10% of £7,700 means that you'll be paying £770 in capital gains tax. Hopefully that all makes sense. There's a lot of numbers, I know, but if you watch it back a bit, I'm sure it'll become clear. So, that is a basic overview of how we pay tax on our cryptocurrency investments. Now, we can get onto the important bit, which is how we can avoid paying tax on our crypto gains. Well, since cryptocurrency is such a new asset class, we unfortunately don't have the same tax saving infrastructure that we get with some other assets. By this, I mean we can't just shove all of our crypto into a stocks and shares ISA, because they're not stocks and shares. Maybe one day we'll get a crypto ISA, which will give us easy access to tax-free crypto investing, but that day is not today. Until then, we have to be smart with our investments to make sure that we minimize the amount of capital gains tax that we pay on our gains. So with that, on to tip number 1, which is making sure that you're fully utilizing your capital gains tax-free allowance on your crypto investments. As I just mentioned, we don't yet have any crypto ISAs or tax-free wrappers that protect our cryptocurrency gains. This means that we need to make sure we're saving as much of our tax-free capital gains allowance for our crypto investments. You can do this by making sure that your other investments, like your stocks and shares, are held within a stocks and shares ISA. By using a stocks and shares ISA for your other investments, you can invest up to £20,000 per year tax-free. So, any capital gains that your stocks and shares make within that ISA don't eat away at your capital gains tax-free allowance. By making sure that you're investing in a stocks and shares ISA each year, you're freeing up the entirety of your £12,300 capital gains tax-free allowance for your cryptocurrency investments. This is so important to do because your cryptocurrency investments are otherwise unprotected. One thing that's important to consider is that the tax-free allowance resets every tax year. So if you have a large crypto portfolio that you're looking to sell, it could make sense to sell up to the tax-free allowance each year so that you don't trigger the capital gains tax. Alternatively, if you see crypto as a long-term play, then you may be better off letting the portfolio grow. Then hopefully it'll grow so much that you become a millionaire. And then paying a little bit of tax is going to be the least of your worries. We can only dream. One thing that you may have considered is the possibility of selling your cryptocurrency and then repurchasing it straight away to reset the capital gains. So let's say you had 10k worth of crypto that has now grown in value to 15k. You may want to sell that crypto and lock in the gains of 5k. Then you could repurchase the crypto straight away, and then any capital gains are only triggered from growth above 15k instead of 10k. That way you lock in 5k worth of growth, which is well within your tax-free capital gains allowance, and then you still have all of the crypto that you just sold 5 minutes ago. Well, the problem with this is that there is something in place called the wash sale rule, or bed and breakfasting in the UK. This is where you do exactly what I just described. You try to sell an asset and then repurchase it within 30 days to try and take advantage of tax savings each tax year. The rule prohibits investors from selling a security and then repurchasing an identical security within 30 days. So, if you wanted to do this with your crypto investments, you'd have to sell your crypto and then wait another 30 days before you can buy it back. And recently, we've seen what can happen within 30 days when it comes to crypto. So that's something that you might not want to risk. However, a more effective way of reducing the tax bill that you pay on your crypto gains is through something called tax loss harvesting. This is where you use any losses that you may have locked in from previous tax years to reduce your capital gains tax bill. So let's say you made an investment a year ago that you weren't very proud of. £1,000 turned into £200. After the humiliation, you just couldn't take it anymore. So you sold the asset and locked in the loss of £800. Well, let's say this year you made huge gains on your crypto and you have £2,000 of taxable capital gains. You can use the £800 that you had previously locked in and subtract it from your current £2,000 capital gains tax bill. This reduces your taxable capital gains to £1,200. It just shows that previous investing mistakes can actually be put to good use. You can use any losses up to 4 years after the end of the tax year that the asset was disposed of. So you have plenty of time to use your losses to offset your gains. A final nifty trick that you can use to reduce your capital gains tax bill is through interspousal asset transfers. This is where you give or sell your assets to your husband, wife, or civil partner. Whenever you do this, the assets do not trigger capital gains tax. So if you've made a large amount of gains that you're worried you're going to get taxed on, then you can transfer some crypto to your spouse. Then, when you want to dispose of your crypto, you can both individually make use of the £12,300 capital gains tax-free allowance, essentially doubling your tax-free allowance to £24,600. It's worth noting that the capital gains tax that your spouse has to pay is on the growth from when you initially purchased the asset, not from when the asset was transferred. That said, it's still a very attractive way of reducing your crypto tax bill, and it's an added benefit of putting a ring on it if you didn't have enough motivation already. So that's an overview of how Bitcoin and other cryptocurrencies are taxed in the UK, and some tips and tricks that you can use to help reduce your crypto tax bill. If you have any other suggestions for reducing crypto tax, we'd love to hear them in the comments below. Also, this is the first crypto related video that we've made on the channel, so if you want to see more like this, just let us know. Ultimately, crypto tax can be hard to get around. But with just a little bit of awareness and some sound financial planning, you can ensure that you keep as much of your crypto gains as possible. More gains, more fun, more rocket rides. I'll see you on the moon.